Julia Coronado. She is the founder and president of MacroPolicy Perspectives. Julia, what do you think about what Steve just laid out?
I think it makes a lot of sense. Look, they're going to go next week. They are going to raise rates 25 basis points. It's fully priced. They think because it's fully priced, to not do it would be to ease policy, and they're not ready to do that. And I agree with Steve. He's not going to tip his hand about the next move. It's meeting by meeting. It's data dependent. He'll still probably indicate that the bias is to do more. But we think it's the last hike because the next two inflation prints we expect to be in the same zone as the one we just got for similar reasons. And that's going to be an accumulation of evidence that kind of confirms, why are you hiking rates if inflation is on a monthly basis, essentially very close to your target?
So even if they do what people are anticipating, potentially a hawkish hike later this month, you're not buying it. You think this is one and done.
Right, yes. But because they're data dependent, this is how we think it'll play out. By September, they'll have enough data that they're going to have to lower their inflation forecast. They have a very well above consensus inflation forecast for this year, 3.9% on core PCE. The way inflation is running, there's no way we're going to get that. And so at the September meeting when they refresh their forecast, they can lower that forecast. That will be the first downward revision in a long time. And then that will be the motivation for taking that next hike out of their baseline. They'll still say they can do more, right? They will still say that if inflation resurges or if the data don't continue on this track, they can do more. But I think we see the dynamics of inflation as sustainably moderating from here.
Steve, you look like you agree.
I wanted just to give you some numbers. I should have had these earlier. I'm sorry I didn't. But the Fed itself, the median forecast for next year is 4.6. You guys are the experts on when the market starts incorporating that, but that's there right now. Now, just be careful because the PCE forecast is 2.6. So the real rate they forecast is 2%, which is actually a little bit higher than they have this year. But I think there's an interesting dynamic that could be at play. Money now is not just more expensive, but more expensive than it ought to be. And what I mean by that is the credit spread, for example, of mortgages over the 10-year is like a percentage point higher. Why is that? I think it's because the mortgagers are protecting themselves against further upside. If the Fed starts a downside trajectory, even if it's remaining 2% tight on real, you could take off that expensiveness in money, that extra percentage point that's there to protect lenders.
Mortgage spreads.
That makes sense.
Mortgage spreads could come in. Other lending could come in because I don't have to protect myself from the possibility the Fed goes the other way.
Well, once things stabilize, everybody can settle out and figure out what's going on.
And QT is a big part of that too, right? They are still selling treasuries and mortgages or letting them roll off.
We don't talk about that enough, Julia. How big of an effect is it having, do you think?
I mean, on the mortgage market, I think it has a pretty important effect. So if and when they actually stop or taper that process of letting mortgages roll down, now, of course, they want to get to a Treasury dominant portfolio, so they may continue the mortgage roll down for a while. But I think it is something that keeps those mortgage spreads wide. And so whenever that decision is made, I think both the combination of the end of the rate hikes and the end of QT could bring mortgage spreads in.
If you think all this is happening, that really sounds like a soft landing scenario. You think we can get rid of inflation and not have the jobs market weaken significantly?
Well, yes. I mean, I think one of the things that we're seeing in the inflation data is that the supply side is finally lending a helping hand. So areas that were very soft and actually showed price declines in June are areas where consumer demand is just fine. Airfares, cars, people are still buying cars, people are still traveling, but they're more price sensitive and there's more supply. So airlines are now fully staffed up and car production is ramping back up and there's inventories on the lots. So now it's sort of back to sort of a more pre-pandemic style dynamic where you can bargain with your car dealer and they have to cut you a deal.
I'm so superstitious about this
by saying
I feel like as soon as I say
jinxing it.
that we're done, we don't have to worry about recession, that's when it's going to hit us.
Right.
Yeah. A lot of people feel that way.
I have felt
Knock
really
on
good
wood,
about not thinking we could avoid the recession, but it's like saying the plane is going to be on time.
Yeah.
Well, we are in a world of high real rates, and that does probably mean there will be bumps along the road. Right now, we're in a good streak of data, but money is tighter. It's more expensive. That's going to probably mean growth is more uneven.
Yep.